Everyone online is screaming about penny stocks going parabolic, but most people never stop to ask one simple question: how many of those stocks actually survive long enough to matter? In today's video, we're slowing things down and looking at penny stocks based on real business activity, real risks, and real market narratives. Not hype. Stay until the end. Because the last stock on this list is one most retail investors completely misunderstand, and that misunderstanding is where both the biggest risk and potential opportunity live. Before we begin, this video is not financial advice. Penny stocks are volatile, speculative, and risky. This is a watch list designed to help you think, not to tell you what to buy. Now let's start with why penny stocks still matter in the current market environment. Even after years of rate hikes and market shakeouts, many people assume penny stocks only move in bull markets. But history shows something different. Penny stocks often move when narratives shift. New technology cycles, government contracts, AI infrastructure, or sudden changes in investor attention. The question is not, will this go parabolic? But does this company have a real reason to exist in the next 5 years? Keep that question in mind as we go through each name. Let's start with a company that sits at the intersection of energy storage, defense, and industrial technology, Kohler Technology Group. What makes Kohler interesting is not its stock price, but its focus on thermal management solutions. In simple terms, Kohler works on keeping batteries and electronics from overheating, which sounds boring until you realize how critical that problem is for electric vehicles, aerospace, and defense systems. The hook here is this: overheating is not a future problem, it is a current bottleneck. If battery usage grows, thermal management becomes unavoidable. The risk is clear though. Kohler is still a small company, heavily dependent on contracts and execution. This is not a growth story. It is a survival story, and survival comes before parabolic moves. Now here's where many investors lose interest too early. Penny stocks are rarely about revenue today. They are about relevance tomorrow. That brings us to a company many people argue should not even be called a penny stock anymore: SoFi Technologies. SoFi operates in digital banking, lending, and financial services, targeting a younger, tech-native audience. The hook with SoFi is this: it is not trying to beat big banks at being banks. It's trying to replace the user experience entirely. The major risk is exposure to interest rate cycles and credit quality. But the reason SoFi stays on watch lists is simple. It already has millions of users. Most penny stocks dream of users. SoFi already has them. The market is not asking if the app works, but if the business model can remain profitable long-term. Here's something most videos won't tell you. Stocks don't move because they're cheap. They move because attention shifts suddenly. That brings us to Gorilla Technology Group, ticker GRAR. This company operates in AI-driven security and data analytics, with a focus on government and enterprise clients. The hook here is psychological. Governments do not move fast, but when they do, contracts can be large and long-term. The risk is obvious: dependency on a small number of deals and the uncertainty of execution. The opportunity is narrative-driven: AI plus security plus government. Demand is a combination the market repeatedly revisits. Whether GRAR succeeds or not depends less on technology and more on credibility. Now let's talk about a name that sits directly inside the AI infrastructure conversation: Rigetti Computing, ticker RGTI. Rigetti works on quantum computing, which is still early, experimental, and extremely risky. Here's the hook: quantum computing does not need to be mainstream for these stocks to move. It only needs renewed belief. The risk is severe: cash burn, competition, and timelines that stretch for years. But penny stocks tied to frontier technology often trade on milestones, not profits. Investors are not buying what quantum computing is today. They are betting on what it might represent 10 years from now. That gap between reality and imagination is where volatility lives. At this point, you might notice a pattern. None of these companies are guaranteed winners. That is the uncomfortable truth about penny stocks. Which brings us to the most important concept in this video: risk management. The hook here is simple. Most people don't lose money on penny stocks because they pick the wrong stock. They lose money because they size the position wrong. Penny stocks should never be core holdings. They are satellites, not foundations. Another mistake retail investors make is confusing price with value. A stock trading under $5 is not cheap if the business is broken. That's why every stock on this list has one thing in common. It represents a real sector: energy storage, fintech, AI security, or advanced computing. These are not random shells. They are businesses trying to survive in competitive spaces. Now let's talk timing, because timing is where emotions take over. Penny stocks often spike on news, then collapse when expectations outrun reality. The hook here is patience. Watching volume filings and business updates matters more than daily price movement. If you can't explain why you own a stock without mentioning the price, you probably shouldn't own it. Another critical point is dilution. Many penny stocks raise money by issuing new shares. This keeps the business alive but hurts shareholders. Smart investors watch cash burn and balance sheets more closely than headlines. This is boring work, and that's exactly why most people avoid it and why disciplined investors survive longer. So what is the realistic role of penny stocks in today's market? They are not lottery tickets. They are asymmetric bets with known risks. One winner rarely makes up for 10 reckless decisions. The hook here is mindset. Treat penny stocks as research exercises, not shortcuts to wealth. As we wrap up, remember this: every parabolic chart you see online hides dozens of failed companies no one talks about. The goal is not to predict the next explosion, but to avoid the next collapse. If even one stock on this list survives and grows into a real company, that's success by penny stock standards. If you found this breakdown useful, consider subscribing for more calm, realistic market analysis focused on thinking clearly instead of chasing hype. Let me know in the comments which stock you're watching and, more importantly, why. Sometimes the explanation matters more than the ticker.